Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang, and we are looking at bank earnings this morning. And we've got OCBC in focus. They've posted a net profit of $1.69 billion for the fourth quarter ended December. That's up 4% from the previous corresponding period. And that is short of the consensus forecast in a Bloomberg survey of 5 analysts, which was at $1.78 billion. We did get group net profit being driven by robust income growth across its 3 key businesses and lower allowances. To break it down further, we've got some help from Jane Mahmud. She is the senior analyst at Bloomberg Intelligence. Sarah, good morning. How are you doing today?
Good morning. Thank you very much for having me.
Great having you on. So let's dive into the numbers first. With your overview of how OCBC's results came through for you, how impressive or not is it for you?
Sure, thank you. So for 2024, OCBC reported profit growth of 8%, which was a modest miss of consensus forecast. As you said, this was led by non-interest income gains of 22% on very strong wealth fee growth and contributions from its insurance business, Great Eastern. Now, given non-interest income represents around a third of OCBC's total revenue, its growing insurance and wealth business can help offset weaker net interest income gains, up only 1% last year, as rates are starting to fall, supporting bottom line growth. And I think with many more opportunities for cross-selling, this will also support OCBC's long-term strategic agenda to capture rising wealth in Asia. Now, the 2.5 billion Singapore dollar capital return plan was, of course, one of the key highlights. This was widely anticipated, with the bank having a much bigger capital buffer than peers and estimates of over 3 billion Sing dollar in excess capital. So essentially, the bank's planning to return 2.5 billion Sing dollars to shareholders through a mix of special dividends and share buybacks between now and 2027, which should bring the total payout ratio to around 60%. And this, of course, does follow similar announcements from peers DBS and UOB in recent weeks.
That's right. So just taking a closer look at some of those numbers, zooming in on net interest margin. So for the full year, it's at 2.2%, down from 2.28% in the prior year. So if you look at what they've mentioned, this was due to a rise in funding costs, which outpaced the increase in asset yields. So if you look at the rates environment that we are in right now, with the Fed expected to cut to some degree down the road, how does this affect banks? And of course, how much is going to be offset with the loans outlook from where we are right now?
Yeah, sure. So a slower pace of Fed easing, with around 2 rate cuts now forecast this year compared with 9 which were forecast before the US presidential election, should actually soften the pace of margin compression into 2026. Now, OCBC and its peers are expected to post only a modest rise in net interest income this year, with margin likely to narrow by around an average of 4 to 5 basis points. And our calculations show this could limit pre-tax income by a combined 700 million Singapore dollars, with DBS actually more exposed to interest rate fluctuations than its peers. Now, like DBS and UOB, OCBC has also been taking a number of steps to reduce its interest rate sensitivity, including hedging deposits, adding duration to asset yields, and also increasing its exposure to fixed rate lending to strengthen its asset liability risk management. But I do think for all 3 banks, a pickup in lending activity led by the corporate segment, along with, as you mentioned, relatively stable credit costs and a very strong uptick in non-interest income driven by this growing demand for wealth management services, will help support revenue growth as the year goes on and into 2026.
All right, taking a closer look at what is also on the table in the coming year, a lot of uncertainty from where Washington is when it comes to some of its tariff policies. So when you look at the potential trade war that might play out between the US and China or even escalate, what is the likely impact on the 3 banks?
So I think a new trade war could strengthen Southeast Asia's overall position as a manufacturing hub. And this could, of course, present sizable opportunities for the region's biggest banks. So OCBC, DBS and UOB would be the major 3, all of which do have sizable operations in both Southeast Asia and China. Now, OCBC could be favorably positioned here, given its ASEAN Greater China growth strategy, supporting increased trade flows between the 2 regions, by helping companies set up in Southeast Asia. And I think trade tariffs could also actually position Malaysia, especially with the Johor Singapore Special Economic Zone, well in the long term. And this could help attract supply chains to the region, presenting significant opportunities for OCB, which has very deep growth both in Singapore and in Malaysia.
Yeah, so we've got that in focus as well. The Johor Singapore Special Economic Zone could bring in some benefits for the banks as well, especially if their exposure there. Now, take a look at where the economy is going for both the US and China, especially for some of these banks with exposure to China. Where do you see that playing out when it comes to the Chinese economy?
The Chinese economy isn't something that is within my coverage area, but I would say that the banks that I'm looking at in Singapore, also in Southeast Asia, are seeing growing demand for wealth management services, and they are looking to tap trade flows between Greater China and Southeast Asia. UOB, for example, yesterday announced that it is selling its Chinese retail arm to strengthen its strategic focus on supporting trade flows between the two regions. So this is a key focus area for all three of the Singapore banks going forward.
All right, plenty to watch. And talk about potential challenges for some of these three banks. We've got digibanks in the equation these days. And of course, this includes the likes of GXS, Marybank, Trust Bank, ANEX, Greenlink as well. How much headway have you seen them breaking through into the market so far? How much of a challenge are they posing right now?
It's very interesting. There's always a lot of excitement around the digital banks across Southeast Asia. But I think in Singapore, the growth of digital banks led by Trust pose only really a modest threat to the three incumbents who essentially were forced to speed up their digital transformation process during the coronavirus pandemic. And between them, the three own around a 65% market share in the domestic deposit market. And I don't think this is really likely to slip materially. And when you think about it, only around 2% of the population here in Singapore don't have a bank account. So digital banks could struggle to win deposit market share. And also, we're still in this elevated interest rate environment. So the high interest rates to attract savers are not really sustainable on a large scale or over the long term for banks that are seeking to scale up. So even though we don't see significant growth opportunity for digital banks in Singapore, we are seeing very strong growth in Indonesia, for example, where the digital banking sector could potentially grow a lot faster than in most Southeast Asian nations. And over there, banks do have much bigger scope to tap the unbanked and the underbanked segment, with around 70 to 80% of adults and micro, small and medium-sized companies struggling with limited access to financial services.
Yeah, still a tough road to profitability for some of these banks. Based on my latest numbers for Trust Bank, FY 2023, they made a loss of $128 million. GXS Bank showed a loss of $152 million. So definitely a lot of work on their plate to break into the market further. And we've been in conversation with Sarah Jane Mahmud. She is the senior analyst for Bloomberg Intelligence. Sarah, great chatting with you, and thanks for your time and insights this morning.
Thank you very much.
Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.